So I'd like to dispel a myth that's out there about options trading. It came up in a mentoring session that I had with one of our students about a month ago, and he brought up the idea that you ultimately can always win by trading, selling short puts below the market. And his idea was, you get below the market, you short a put, naked put, and then if the market sells off and you're in some kind of danger on that put, you just roll it down, sell more, get enough credit to pay for the cost of rolling that put down, and then you'll make money on the trade if the market bounces after that. This is kind of a silly idea, and my first reaction to the student was, that'll work. I guarantee you that will work. So it's a great idea except for two things. Number one, you need an infinite amount of capital, and number two, you need to have zero emotions. I've never met anybody who has either of those actually, but if you happen to, then go ahead and knock yourself out and do this trade. So the premise is logically true. If you sell a short put and the market puts that in some kind of danger, you're down money on it, you can always roll it down. That's true. The problem is that it's not realistic. And let me give you a very good example of why. Let's go back to August of 2014 and 2015. And as you can see, and admittedly, this is right before a big sell-off in the market, but big sell-offs in the market happen, as you all know, such as February of this year. And when they happen, it gets ugly, and you often have no idea. In fact, I would say you almost never have an idea that it is definitely coming. You may have a feeling, you may have bad vibes, but you can't know for sure that it's definitely coming until it's there. And so let's take a look at if you had entered this trade and shorted the 2040 SPX puts on August 17th. At that time, you would have received a credit of $3,500 if you sold 10 of them. And your broker would have margined you $250,000 approximately for getting into this trade. So you think you're risking $250. You want to make $3,500. You're way below the market. You're at 10 delta, which approximately means there's only a 10% chance that option will close in the money, or that the market will close below that option strike price. But nonetheless, it's near enough to the market that there is potential for risk there. So that's how the trade starts. Now let's go forward a few days to August 20th. Now the market starts selling off. And let's say your protocol was that when your delta of your short put gets to 20, you're going to roll it out of trouble. Increase the number of lots, get enough credit to pay for your roll, and you're back into positive cash flow. If the market bounces, you'll make money, right? Well, let's take a look at what happens here. You roll down to the 1970 strike. Your P&L at the time of the roll was negative $12,000. Remember, you're trying to make $3,500 out of this thing. Now you're down $12,000, and your capital has risen to $800,000. Why? Because you needed to increase your lot size to 35. Why did you need to do that? Because you had a large enough loss in the original put that you needed this many short puts farther out of the money down at 1975 to restore the credit. So now your capital is up to more than 3 times what it was when you started, and you're down $12,000. And you're 3 days into this trade. Now let's move further to August 21st. Now on August 21st, the market started to sell off again. Your short put got to 20 deltas or more, so you had to roll down to the 1925 strike, and you had to roll down 75 down to that strike, increasing your lot size again. Your loss at the time of the roll was $41,000. So now you're trying to make $3,500. Instead, you're down $41,000. You wanted to use $250,000 in capital. Now you're using $1,580,000 of capital. So this is this great idea of just continuing to roll out of trouble. Later that day, your short strike got hit again. So you're now down $93,000. You've had to roll out of the 1925 position into the 10 delta position at that moment in time, which necessitated you using 145 short puts to restore your credit. And I mean just barely restoring your credit, by the way. And now your capital level is up to $2.7 million. So let's review the bidding here. You were trying to make $3,500 on $250,000 of capital. Now you're down $93,000, and your capital is up to $2.7 million. You think you'd keep going? It's a Friday afternoon, August 21st, by the way. Well, guess what happened on Monday morning? On Monday morning, the market gapped down again. It gapped down so hard that you had to roll your short put down yet again. Your loss at the time of the roll was $388,000. You had to sell 405 puts now at 10 delta. And your capital, as a result of having to be short 405 naked puts in the middle of a crash, was $7 million. So let's review what's happened here. You're trying to make $3,500. You're down, you're using $250,000 of capital. You're into the trade for a week, and you're down $388,000. And you're now using $7 million of capital. Now, how realistic is this? No one has no emotions. And no one has an infinite amount of capital. And even if you did have a spare $7 million to throw at this disaster, would you? And that's where your emotions come in. And the answer with almost all humans is no way. Let me tell you what would actually happen here. What would actually happen is, in the middle of this mess, either your broker would have margined you, unless you happen to have $7 million in your brokerage account. You would have received a margin call, and your broker would have started to automatically, electronically liquidate your position, freezing the loss where it was. Or, alternatively, you would have emotionally panicked out. And that's really more likely. So you cannot trade with a notion that if you have enough capital, you're going to win. That is theoretically, mathematically, a fact. That's a true statement. If you say that, that's true. The problem is, I've never met anyone who's actually willing to trade that way. You are not going to be able to trade that way, and you will have a horrible outcome if you try to do something like this. Now, I meant to say, do something like this, because there's a close cousin to this trade, which is to sell a put credit spread and do the same thing, keep rolling down, increasing your lot size and so forth. You're going to run into the same basic problem. Maybe it would be modified a bit by the fact that you have a long put below, but you would be pretty disappointed at how little you're going to get out of that trade versus how much you will get nailed if something like this were to happen. So don't trade with the premise that you have no emotion and unlimited capital. It's not realistic. It's going to lead to disaster. Neither are true. You have limitations in capital. You have emotions. You're going to trade in the context of both of those realities. So face it, as opposed to something really, really silly like this particular student was suggesting.